Hello and welcome to 5-Year Club video number 73. Tonight is going to be a simple video. Last night I discussed the horrendous stock market returns between 1999 and 2009. And tonight I want to discuss 10-year stock market returns. Specifically, I want to discuss returns from stocks versus returns from bonds over 10-year periods in the past. So if you're invested for 10 years in the stock market, how often will you outperform bonds? All right, and T. Rowe Price in 1999 released an article that I think does the job in terms of reviewing the historical data. So we're going to read that article. Stocks versus bonds, a decade of record disparity. Among the many market anomalies resulting from last year's global financial crisis, remember this article is from 2009, so they're talking about 2008, and stocks' abysmal performance over the past decade is the gaping disparity between stock and bond returns. So when they say over the previous decade, they are referring to 1999 to 2009. The chart on this page illustrates the striking performance difference between the annualized return of the S&P 500 stock index and 10-year Treasury bonds over rolling 10-year periods, measured on a quarterly basis, starting with the period ended 1926. Stocks are generally more risky and volatile investments than bonds, but their 10-year return has exceeded that of Treasury bonds in 85% of these periods, according to the Luthold Group, a market research firm. However, for the decade ended March 31st, 2009, stocks underperformed bonds by a record differential in annualized returns of 9.8 percentage points. During that decade, the S&P 500 had an annualized return of minus 3%. And I want to point out right now that as of March 31st, 2009, yes, this article is accurate. Because this article was written in 2009, they don't know yet in the article what's happening in the future. So they can't announce in the article the fabulous stock market returns from 2009 to 2017. That's just a fact. Stocks also lagged bonds during the 20 years ended March 31st, marking only the third 20-year period that this has occurred since 1926. This goes a long way to explain why confidence in the stock market has been so difficult to rebuild, especially among individual investors, says Eric Jorgen, a senior research analyst with Luthold. And I'm going to show you this chart now and continue reading. A perfect storm. Of course, the past decade was a perfect storm for equity investing, beginning with record valuations in early 1999, particularly for technology stocks, and featuring the two worst bear markets since the Great Depression, with the latter bear market causing a flight to quality, in other words, quality bonds, Treasury bonds, that pushed Treasury yields to record lows. In other words, the more people who want Treasury bonds, the higher their price. The higher their price, the lower the yield, because the yield stays fixed, but the price goes up. Because the past decade has been so bad, Luthold notes that the stock versus bond total return differential was at or near all-time lows over the 20, 25, 30, 35, and 40-year periods as of March 31st, 2009, challenging the widely held view that stocks outperform over the long run. What the point is here is really that 2009, March 31st, 2009, the stock market prices had dropped so low on that day. And that was the market low, by the way, March 31st, 2009. I remember it because I made an offer on the condo in March, was it March 28th? No, I'm wrong. February was when I made the offer on the condo, and I think in my head, like, oh, that was basically at the market bottom. Wasn't quite at the market bottom. I think the market bottom was actually 5 days later, but point is, the market bottom was only a month before March 31st, 2009, so it's really close to the market bottom. And the point I was going to make is that the market dropped so low that if you pick March 31st, 2009 as your measurement point, yes, like the performance of stocks versus bonds right then at that moment was super bad, to the point where over 20, 25, 30, 35, and 40-year periods, it still looks horrible. But if you were actually the investor who was holding this stuff and you simply stayed in the market and, waited a little bit, you got all your money back. And so things were not so bad. While this historical performance may discourage equity investors, it also may signal a rare opportunity to shift some assets from bonds to stocks, and that is 100% true. If you had shifted assets from bonds to stocks in March 2009, you did extremely well on your money. As reflected in the chart below, on the rare occasions when the stock-bond performance differential turned negative, the stock market was bottoming and significant equity outperformance followed. And that's exactly what happened from 2009 onward. Leuthold notes that after the differential hit a low in the second quarter of 1932, for example, the stocks achieved an annualized return of 33.8% over the next 5 years, compared with 4.6% for bonds. After the other 20-year period, when bonds outperformed, ended in the third quarter of 1949, the S&P 500 gained 23.1% annually over the subsequent 5 years. This compares with only 1.6% for 10-year treasuries. Mr. Jorgen concludes, from a variety of vantage points, the table appears to be set for equities to substantially outperform fixed income over the next several years. T. Rowe Price bond managers agree. I would not expect the bond outperformance we saw over the last decade to continue, says Stephen Huber, manager of the firm's Strategic Income Fund. Treasury yields were much higher 10 years ago than where they are today, so there is not a lot of upside for capital appreciation from here, though we do see upside in some other sectors of the fixed income market. The expected reversal in stock-bond relative performance may have already begun. In the second quarter, the S&P 500 rose 15.9% compared with a minus 6.2% for 10-year treasuries as equities staged one of their most powerful rallies since the 1930s. All right, so what is the point here? What is the takeaway here? The takeaway is, number one, 85% of the time when you're invested for 10 years, stocks outperform bonds. So if you have an investment horizon of 10 years ahead of you, it is very likely that putting your money into stocks is going to be better than putting your money into bonds. Period. And I'm not telling you the stocks are going to do amazing over the next 10 years. I'm telling you that the stocks will simply do better than bonds, because you're going to have to put your money somewhere. In some cases, that 10-year investment period is going to be picking the cleanest dirty shirt. It's going to be picking the thing that is least bad. And 85% of the time, stocks are less bad than bonds, or put it a different way, stocks are better than bonds. But there are time periods that we can find where stocks do not do as well as bonds. However, it's also clear from the historical data that when you look at the particular year that you end on, where you say, okay, for the past 10 years, stocks did not do better than bonds, typically you can just wait for 2 years, 3 years, and stocks are now, you've now made more money holding stocks than you would have if you had held bonds for that 12 or 13-year period. What this means is that if you can just hold out during those dips where things look really bad, you will come out ahead. And I talk about over and over again that I want to lower fixed costs, that I think fixed costs are really bad for people. This is one reason. If you have high fixed costs, it's hard to hold on to the portfolio for those 2 or 3 years because you're spending so much. But if you have low fixed costs and you have more flexibility in the amount of cash flow that you need to realize from different sources, it's easier to shift things around and not touch that stock portfolio so that you get out of this temporary dip. And the major dips in the stock market are typically short-lived. The major dips in the stock market are typically short-lived. I think what we actually have to worry about more is not major crashes in the stock market that produce these deficits against being invested in bonds. What we really want to worry more about is just like very low performance for a long period of time. Because we may be doing better than bonds, but the performance is so low that we are not building the nest egg that we need to retire as efficiently as we would like. Okay, that's it for video number 73. I hope you enjoyed this article. I'm going to put a link to it in the description so you can read it yourself. And that's it. Have a great evening.